Hey everybody, this is That Real Estate Bro coming at you with my second video in my Real Estate 101 series, and I want to talk to you about the comparison between PMI and a 20% down payment. A lot of people think, wait till you have 20% for a house in order to avoid PMI, but PMI really isn't a bad guy, and I want to break down for you why that is. Be sure to check out our Facebook page at Alex and Deb Sell Charleston and my Instagram page at That Real Estate Bro to keep up with a whole bunch of things going on in the housing world, but also keep up with me and my wife and our life and what's going on. Sometimes really cool and exciting, sometimes kind of boring, but either way, I want you to check it out because I think you'll enjoy it. Without further ado, let's go ahead and get started. So, PMI stands for Private Mortgage Insurance, and it's basically an insurance policy that your mortgage lender takes out against you and your mortgage in the event that you default on your loan and they have to go through the foreclosure process. They do it to try to protect the return on investment because every home with less than a 20% down payment requires this additional insurance. But that doesn't mean that PMI only benefits the mortgage lender. It also benefits you and as the buyer, and I'll tell you why. So even though PMI is an additional fee on your mortgage that doesn't go into the equity of the home, it allows you to purchase a home with a much smaller down payment and start creating wealth sooner rather than later. Granted, with a 20% down payment, you'll have more equity in the home up front. Your mortgage will ultimately be lower, and you also avoid having to pay that additional fee. But that doesn't mean that paying 20% is 100% the way to go. And I want to give you an example. The current average home price across the nation is just under $255,000. In order to avoid PMI, you would need a 20% down payment, which brings you close to $51,000 before even adding other closing costs that you may have to do and pay for as part of the sale. So that ends up being a really expensive day. Taking that a step further, it's going to take you about 3 to 5 years just to get that 20% payment put together. During that 3 to 5 years, which probably more, I can't pay that quick, but within that 3 to 5 years, homes are appreciating in value, and mortgage interest rates will most likely continue to rise. So you'll find yourself getting stuck in the hamster wheel of focusing so much on saving money that you're actually losing buying power and hindering your ability to create wealth sooner. And that's where PMI becomes the good guy. It's a lot easier to get 3% or 3.5% down on your home and start putting equity in the home, because in that same 3 to 5 years, while this other guy over here is still trying to save all his money, you're putting money into the equity of a home, sometimes the same or less expensive than what you were paying for rent, but also the appreciation value on that home it's continuing to increase. So you're actually putting money into basically more or less a long-term savings account. Of course, this guy's going to end up coming out on top once he gets to the 20% point, but also by the time he's buying his first home, you might have already moved on to your second home, and that first home you had is now a rental property, and now you continue having an appreciating asset. But it actually doesn't stop there. One thing a lot of people don't realize about PMI is that once you have more than 22% equity in your home, which includes the money you've put into it as well as its rate of appreciation, contingent on an appraisal for your mortgage company, you can actually apply to get that PMI removed. So depending on how long that takes or how quickly you get that 22% equity, you could end up saving that money a lot sooner than you thought. If you did get an FHA loan, that's a little bit different because the PMI has to stay on that because it's a government-backed loan. We'll get into that on the next video. But even in that situation, you could still refinance with another mortgage. And at that point, you already have equity in the home. Mortgage rates, depending on where they're at, you might get a better or worse rate than where you are at. It gives you more time to, pay off bills and debts and other things that you have in your way. So regardless of how you look at it, PMI isn't really as much of a hindrance as a lot of people make it out to be. Granted, having 20% down for a house is definitely a smarter option, given the fact that you have the ability to quickly get that 20%. would, to me, be the only difference. But I'll let you decide that for yourself. Honestly, again, like I said last video, the best time to buy a home is when you feel like you're ready to buy a home. So take what I say for what it's worth, but that's basically the difference between a low down payment PMI loan and a 20% loan, and why you shouldn't necessarily discount or prevent taking out a mortgage in order to avoid paying that PMI. That's it for this video. Again, on the next video, I'm going to break down the different types of mortgages a little bit more, so stay tuned. Take care.